Okay, good morning, my dear future chartered accountants. Hope everybody is doing great. Can you please confirm that my voice is audible and the PPT is visible? Okay, I assume it is audible. Now we are going to understand various parity theorems. Parity theorems, like we have interest rate parity theorem, purchasing power parity theorem, Fisher effect, international Fisher effect, and so on. And also, based on that, we are also going to understand about arbitrage strategies and little later hedging using money market, foreign currency, something like that. Okay. Now, parity theorems, first one among them we have is purchasing power parity theorem, PPPT, which basically says between the two countries, how do you determine the exchange rate? Is based on the product they are going to purchase, and two markets cannot have two different values. Let me give a quick example. Suppose you think of masala dosa being a breakfast time. uh, in India, suppose you can purchase that masala dosa for 50 rupees. In US you can purchase the masala dosa for $1. Therefore, the implied exchange rate should be $1 equals to 50 rupees, because the product you can purchase is same across two countries. So, just like the barter system, if you can purchase 2 kg of rice equal to 1 kg of sugar, then what is the cost? Accordingly, you are going to determine the price. So in India, you can purchase one masala dosa for 50 rupees. In US, you can purchase one masala dosa, same thing, for $1. Therefore, implied rate $1 is 50 rupees. But suppose in US it is not $1, it is $2. Then what you can do? Since it is cheaper in India, you buy in India, sell in US. That's called as arbitrage. Buy at a cheaper rate, sell at a higher rate. So, but where do you have the money? And arbitrage process should always start with the 0 rupees. So, we borrow 50 rupees. In that 50 rupees, in India, you buy one masala dosa, you go to US, and you sell that masala dosa for $2. Come back to India, you get it at, you convert it at 100 rupees, you borrow 50 rupees, you repay 50 rupees, ultimately, you're having 50 rupee riskless profits. That is what is the parity theorem is trying to tell. Parity means equal, something equal, parity theorem. So the currency may be different across two countries, but when you compare their implied exchange rates, you cannot have two different price, or you can say law of one price. Means the ability to purchase the product in the two countries are same. That is purchasing power parity theorem. Quickly, I'll give one more example. I'm not sure I've given it earlier. Uh, One time I went to Indonesia, Bali, and there I've witnessed one Indian rupee is 200 Indonesian rupee. I have always witnessed other way around. $1 70 rupees, 1 pound 80 rupees, 1 euro 80 rupees. That's the first time I've seen 1 rupee is 200 Indonesian rupee. I had 1 lakh with me. So when you convert, how much you had? 1 lakh into 200. You had 2 crores. In a matter of few hours, I became crorepati. 2 crores. I was very happy. But when I went to that airport, I reached that airport, reality struck me. Even if you have to go out, go to bathroom, you have to pay 2000 rupee there. If you convert it to Indian rupee, 2000 divided by 210 rupee. In India, we don't pay 10 rupee and all. Maximum 2 3 rupees pay, and some people don't pay that also, you know it. So purchasing power parity theorem means law of one price. The currency rate may be, the price may be different, but the ability to purchase will be same, or other way around, we can tell as per purchasing power parity theorem, the implied exchange rate is the ability to purchase the same product. Ability to purchase the same product. Ability to purchase the same product. Uh, if implied exchange rate is different from the actual rate, if implied rate is different from actual product, if implied rate is different from actual rates, if implied rate is different from actual rate, then we have, then there exists arbitrage opportunity. There exists arbitrage. So ideally, whether a company starts a business, let's say software business in US or in India, that should be same as per this theorem. But we have an arbitrage opportunity here, which means the cost in India is less. There is an arbitrage. That's why many companies come to India and start their software business. So basically the value of two products. If I give you a simple example, suppose in US a phone costs $1,000. In India, the same phone cost 70,000 rupees. Same phone, huh? Same quality. Now $1,000 equal to 70,000 rupees. That means, can I say $1 equal to 70 rupees? This should be the exchange rate. If not, then there exists arbitrage opportunity. That's what purchasing power theorem says. Okay, this is spot rate. What about forward rate? Forward rate should be adjusted based on the increase in the prices. How this cost of the phone increase in India, how this cost of the phone increase in US. That is, we say the implied forward rate is based on inflation between two countries or two currencies. Inflation rate. So what will $1,000 will become? What will 70,000 rupee will become? In other words, implied forward rate. Actual forward rate, depends on demand supply. But implied forward rate formula is given by spot rate into 1 plus local inflation divided by 1 plus foreign inflation. So in Indian context, if you see, local inflation will be rupee inflation, foreign inflation will be dollar inflation, or whichever currency you are calculating. So in Indian context, you can understand the local and foreign easily. What if they give you European and one euro and one USD? Then local foreign becomes difficult. In that case, for easy memory purpose, you can remember local is like right hand side currency inflation, foreign is the left hand side currency inflation. So if I tell you $1 equals to 1.7, or let's say 4.2 Singapore dollar. So Singapore dollar right hand side inflation will become local. US dollar, the left hand side will be in the denominators. Think like that. So basically it is compounded by local, discounted by foreign. Okay. Now mathematically think. If local inflation rate is high, what will happen to the forward rate? When local inflation is high, you see compounding value is high, numerator is high. So basically what happens when local inflation is high, the forward rate becomes high, means the foreign currency is trading at a premium. In other words, can we say a currency which has got lower inflation will be trading at a premium. Currency with got a lower inflation will be trading at a premium. Let's write that sentence also. A currency with lower inflation will be trading at premium. Are expected to trading at premium. One more logic, simple logic. If inflation is less, purchasing power is more. Right? Inflation means increase in prices. So if the inflation is less, the ability to purchase is more, its value is more. And that is why US dollar is valued more than Indian rupee generally. For the reason in US inflation rate is like 1-2%. And nowadays it's crossing their limits. But in India, inflation is 9%, 10%. And that's why our interest rates also high. Everything is connected. So because of lower inflation, USD is generally expected to have higher premium than Indian rupees. Okay. And of course, if implied forward rate is different from actual forward rate, there exists arbitrage opportunity. We buy at a cheaper country, we sell it a higher rate country. So basically, the ratio, if you can also tell like that, if spot rate comes left side, that is ratio between forward rate and spot rate. The ratio between forward rate and spot rate is the ratio between the inflation rates, right? Forward rate by spot rate, local inflation by foreign inflation. So the ratio between forward rate and spot rate is difference between the ratio between local inflation and foreign inflation. Okay, so this is purchasing power parity theorem. Next, we have more importantly interest rate parity theorem. That's a very interesting one and also very important one. So what we just learned, I'll just glance to that. Purchasing power parity theorem, law of one price, currency may be different, but purchasing power should be same in two different currencies. Spot rate, implied rate based on the ability to purchase same quality products. Forward rate is implied rate based on inflation of two currencies. Computation, spot rate into 1 plus local inflation by 1 plus foreign inflation is forward rate. If actual forward rate is different, there exists arbitrage opportunity. That is what we have discussed so far. Okay, now I'll go for purchasing power interest rate parity theorem. Let me quickly cover that as well. Okay, what is interest rate parity theorem? Just like purchasing power, where the product should be same in two countries, the ability to purchase, the purchasing power should be same in two countries. IRPT talks about money market. What is money market? That is borrowing in one country versus another country should not be different. That is, borrowing or investing in two different currencies should be same, should not be indifferent. Whether I take money in India, I invest in US, or I invest in India, or take it in, invest in India itself, or invest in US, both should be indifferent. There should not be a country which is favorable for you to borrow. There should not be a country favorable for you to invest. How will that happen? For example, in India, you borrow at 10%. In US, you can borrow at 4%. Yes, in US, it is cheaper rate available only at 4%. But what will happen when you borrow in India, the US dollar, the dollar will appreciate. If appreciates, so you have to pay that cost also, and that will be, let's say, become 6% appreciation. So when you take a loan in US dollar, interest you pay 4%, 6% dollar appreciate, that is also your cost. So totally 10%. In India also 10%. Effective cost is same. But if appreciation is only 3%, 4% interest rate, 3% currency appreciation, so total is only 7% cost. Now in India currency, India borrowing becomes cheaper. So if both are equal, borrowing in two currencies, or investing in two currencies should be equal. That's what interest rate parity theorem says. If one country is cheaper to borrow, then we say that there exists arbitrage opportunity. So if you start with zero amount, you can borrow in one place, invest in another place, and you can make money out of it. Or if you are planning to take a loan for your business purpose, you can choose, should I take a foreign currency loan, or should I do a foreign currency loan, or should I take a local currency loan? I can make those decisions. Okay. So basically, interest rate parity theorem says parity, something equal. Between the two countries, the two currencies, borrowing should not be different. Investing should not be different, or it should be indifferent. It should be same. A country may have inflation, I mean, and so what does purchasing power parity theorem says? The spot rate, forward rate. What is the differential factor? Or what is the factor which is having the impact? Inflation. Interest rate parity theorem says, I will also agree with you the same formula. Instead of inflation rate, I will use interest rates. So country may have same inflation but may carry different risk in interest. So we should take the interest rate. So I just told you, if borrowing is cheaper, interest cost is saved. Like in India, interest rate is high. In US, interest rate is less. So you save interest in US, but forward rate would have been increased. It should increase ideally. That's what this theorem says. So that will cost you, which will take away all your benefit. In fact, your AS 16, Ind-AS 23 is based upon these concepts only. Anyway, so if you save in money market, you lose in currency market. That is saving in interest, loss in foreign exchange. If you lose in money market, you gain in currency markets. That is, one you lose, other you gain. Both should be equal. That is when IRPT theorem holds good. If it does not hold good, there exists arbitrage opportunity. Let me come to the formula of arbitrage opportunity. So, just like I told you regarding inflation, currency with lower inflation will be trading at a premium. Here also, country with lower interest rates will be trading at a premium. That is same. Country with high inflation will be discounted. It's the opposite. So formula same as purchasing power parity theorem. Forward rate is based upon inflation rate by inflation rate. That is, inflation is substituted by interest rate. So forward rate is spot into 1 plus local interest by 1 plus foreign interest. Compounded by local interest rate. In purchasing power, inflation. And what's the problem with purchasing power? Different products can have different inflation. That is, your rice can have different inflation. The tomato recently have different inflation. Petrol will have different inflation. Your stipend will not have any inflation. So different units will have different inflation, and also difficult to control. It's not predetermined. Whereas interest rate is mostly controlled by the RBI, central banks, and therefore inflation is replaced by interest in the IRPT theorem. If forward rate, this is implied forward rate. If actual forward rate is different from implied forward rate, there exists arbitrage opportunity. Just a summary once more. Interest rate parity theorem, two currencies are indifferent for borrowing and investing. If borrowing is cheaper, then you save in money market, but you lose in currency market because of the exchange rate. If borrowing is costlier, then you lose in money market because you pay more interest, but you save in exchange currency gain. Therefore, another compensation will happen. So forward rate is the implied rate based on interest rate between two currencies. The formula 1 plus forward, 1 plus local interest by 1 plus foreign, compounded by local, discounted by foreign. If the actual forward rate is different from the implied rate, there exists arbitrage opportunity. Means one currency is good for investing, other currency is good for borrowing. And computation is forward rate into 1 plus local by 1 plus foreign interest rates. If actual forward rate is different, that means there exists arbitrage opportunity. But from this, I can do lot of other interpretations, and I would like to give an example for arbitrage also. So let me give some numerical examples because this is important in our decision making process. Okay, just understand. Example, suppose spot rates is $1 is 70 rupees. Spot rate $1 is 70 rupees. Indian inflation or Indian interest rates is, let's say, 10%, and US inflation, US interest rate is, let's say, 4%. So what will be the implied forward rate? Please write along with me. Implied forward rate. Let's write the formula once quickly. Spot rate into 1 plus local interest, that in this case Indian, divided by 1 plus foreign interest. That is, the exchange rate should be the ratio between the interest rates theoretically. So if I apply this formula, spot rate is 70 rupees into 1 plus local inflation, Indian inflation. Indian inflation is easy to identify, local foreign. If it is two foreign countries like Europe and UK, then how do you identify? LHS is foreign, RHS is local. Think that way. So 1 plus local interest, that is the 1 plus local interest is Indian interest 10%, 0.10, and again to be adjusted for time period. Okay, this is full year. If it is 6 months, into 6 by 12, the rate of interest alone, not one full 1 plus rate of interest will be adjusted, time value of money adjusted into 6 by 12 like that, divided by 1 plus 0.04. So 70 into 1.1 by 1.04, 74.038, 74.03846, so 74.0385, 74.0385. And you see, the forward rate is high. Why forward rate is high? Because the US interest rate is less. Currency with lower interest rate is trading at a premium. USD currency with lower interest rates is trading at premium. And also, shall we calculate the premium? Premium percentage. You know how to calculate the premium percentage? We discussed earlier. Forward rates minus spot rates divided by spot rates into 100 into 12 by number of months to express in annual terms. The forward rate is what we calculated. If that is only actual rate, 74.0385 minus spot rate 70 by 70 into 100, and this is per annum basis I'm giving you, so 12 by 12, or you don't have to multiply that as well. So how much percentage you get? 74.0385 minus 70 by 70 into 100, you get 5.7693 or 5.77%. 5.77%. Did you observe one thing now? What is this? Interest rate 10%, US interest rate 4%. What is the difference? 6%. And how much is this number? 5.77, which means interest rate differential is equal to forward premium or discount. It's not exactly equal because of mathematical reasons. Have you taken mathematical reasons? It will round off, but you can write that observation. Interest rates differential between two currencies differential rate between two currency, interest rate differential between two currency is approximately same as forward premium or discount. The interest rate differential between two currencies is approximately same as forward premium or discount. We have to do many more observations. You can write down till here. If you have any questions, you can ask. Okay. Now, how the arbitrage process works. The arbitrage process can be understood as identifying from the implied rate forward rate, or arbitrage process can be understood from the point of view of which country is cheaper to borrow, which country is better to invest. I'll show you both the methods. Okay. Arbitrage process. Okay. Now for arbitrage process, I have created one particular format. Again, you don't see this thing in other places. So learn this format quickly. You will be able to solve the problem very easily. Okay. The first step is it overpriced or underpriced? Always check it. Overpriced or underpriced. How do you compare? You do actual forward rates is more than implied forward rates. Then you say it is overpriced. Right? Actual forward rate is more overpriced. And if actual forward rates is less than implied rates, then it is underpriced. Then it is underpriced. Too simple process, just like the way we have done in futures also. Like in this example, suppose actual forward rates is happen to be 76. And what is the implied forward rate or theoretical forward rate? Implied rates, what we calculated, 74.0385. 74.0385. Therefore, what is the difference or what is the relationship? Actual forward rate is more, correct? 76 is more. So what do we tell? It is overpriced. It is overpriced. Clear? Now, what's the format? The format is very simple, like a P&L balance sheet. In P&L, what are the heading we will have? We will have income expenses, debit, credit, I know, income and expenses. On the balance sheet, we'll have asset and liabilities. So I'm going to write the format like this. What transactions you carry out today and what transactions you carry out on expiry, on due date, on expiry, on settlement, on due date, later. So I'm going to divide into four parts basically. What do you buy and what do you sell, where you borrow, where you deposit. What do you buy? What do you sell? Where you borrow? Where you deposit. Okay. Now, buy or sell depends on whether it is underpriced or overpriced. But now, if it is overpriced, you know what is the rule? If it is overpriced, you need to sell. And what is overpriced? Forward rate is overpriced. So sell forward. Sell forward or forward sell. And if it's underpriced, anything underpriced should be bought. And what should be bought here? That is nothing but the uh, forward rate. That is forward rate is underpriced. Therefore, forward buy. If it is underpriced, forward buy. Now here what do we do? Like in this case, it's overpriced. Since overpriced, our transaction is going to be forward sell. Entered into forward sell. Enter into forward sell. Okay. Now, if it is entering into forward sell, what should we do in spot market? Opposite in spot markets. So, in spot market, spot buy, forward sell dollar and spot buy dollars. Hope you understand. Buy or sell in opposite markets. Buy or sell is in opposite markets. If you are selling in forward market, you should buy in spot market. If you are buying in forward market, you are selling in spot market. Spot and forward is opposite. Same discussion we had in futures also. Right? Now, borrow deposit a consequence. Now, if you want to buy dollars, you want to buy shares, where will the money come from? You need the money, right? You need to borrow money. So here you are going to do borrow rupees. You need to buy the share. You have to borrow rupees. So two opposite currencies. So if you borrow rupees, you are going to deposit dollars. And borrow deposits will always happen in opposite currencies. Opposite currencies. You can't borrow in rupees and deposit in rupees. You can't borrow in dollar and deposit in dollars. That is not suggested. And on expiry, the consequences will happen. But you know, on expiry, settlement always will happen on delivery basis. This is not futures. This is forward. So on expiry, settlement will always happen on delivery basis. On expiry, settlements always happen on delivery basis. Settlement will always happen on delivery basis. Okay, same example I'll take. Spot buy. Now, when spot buy happens, you don't do spot sell. No net settlement basis. So, you will execute the contracts. So, spot buy, the forward sell was there, executes. The execute forward sell. So, what was the forward sell dollar? You have entered 76, right? Forward sell at 76. You are going to sell it, execute. Execute the sell contract. Execute the sell contract. So this spot buy, correspondingly nothing will be there because settlement by delivery basis. Now borrow rupees, how much you borrow? 76 rupees because $1 is costing. No, what is $1 is costing today? 70 rupees. You borrow 70 rupees because you need that $1 and you deposit $1. And this borrowing should be repaid and this $1 will mature, deposit will mature. And what rate you have to repay? 70 rupees into 1 plus rate of interest, 10% in India. So 1 plus 0.10. So 77 you have to repay. and deposit will mature at $1 into deposit will give you 4% interest rate, 0.04, that is $1.04. Now $1.04, what you're going to do? You're going to sell, you're going to execute. So $1.04 into 76 rupees, which will give you 79.04. So 79.04 is what you receive. 77 rupees you'll repay. That's what you pay. And net profit, that is 79.04 minus 76, 3.04. No, not minus 77. Minus 77. 2.04. 2.04. Okay. And how do we verify this number 2.04? This is the difference between 76 and 74.0385. But this is for $1. But how much dollar we executed? $1.04. So please multiply it by that. Or you can say the time value of money, whatever it is. So 76 minus 74.0385. This is for $1 value today. This is per dollar value today. But what will happen after 1 year? This $1 will become 1.04 because of interest 4% into 1.04. You can cross check. It will be equal to this. That's for your verification purpose. 76 minus 74.0385 into 1.04. 2.04, yes, that's what you're getting, approximately the same number. This is one arbitrage process using implied forward rate and actual forward rate. Currency market approach. This is currency market approach. Currency market approach. Currency market approach. We have one more approach, forward the money market approach. That also I can explain. But that also has got some good interpretations. First, you write down. Let me know if you have any doubts. Take some 1 or 2 minutes to read. Get your doubts clarified. So here what we did in currency market approach, which market is cheaper? I mean, spot rate is cheaper, actual forward rate versus implied forward rate. So we identified in which market to buy, in spot rate or forward rate. We are not worried about the interest rate differentials. That is this arbitrage process. By looking at the implied rate and forward rate. Currency market approach, forward market approach. Implied rate for versus actual forward rate. Okay, hope you have taken it down. Next, the same thing I will explain if it is money market approach. Arbitrage process. You can also use it for decision making process. Arbitrage process to arbitrage process where we apply money market approach. Money market approach. Money markets approach. Okay, so now money market means we try to understand which country is cheaper to borrow or which currency is higher, costlier to invest. So we understand which country is cheaper to borrow. Okay, so if I have to understand when is local, if I have to take local borrowing versus foreign borrowing, let's say, local borrowing versus foreign borrowing. If local borrowing, what is your cost of interest? What is your cost of borrowing? Interest rates, local interest rate. What if it's foreign borrowing? What is your cost of borrowing? Foreign interest. But uh, in foreign borrowing, even currency fluctuations you should take it into consideration. If currency appreciates, it's a cost for you, and if currency depreciate, it's going to be gain for you. So I'll say foreign interest plus or minus forward premium. Premium means it's going to be costly plus or discount. Discount means I will subtract. So local interest, forward foreign interest plus or minus forward premium or discount. So very simple. This is a simple model, simple interest approach. It's additive model. Additive model is okay for decision making purpose. You can do approximately. What is multiplicative model? If you apply multiplicative model, to be exact, if you want to see 1 plus local interest, you compare with 1 plus foreign interest plus or minus premium, 1 plus, okay, 1 plus premium or discount, 1 plus or minus premium or discount, 1 plus. I'll show you the example now. Don't rate this example, that's only for understanding, but this formulas you write down. So if IRPT holds good, what is local interest? In this case, 10%. So 1 plus 0.10 equals, what is foreign inflation? 1 plus 0.04, and premium we calculated based on implied rate 5.77%, 1.0577. Please check whether it will be equal. 1.1 1.04 into 1.0577, you get 1.1 exact, right? Hope you understand. Okay, if you want, you can write this also. This is what happens when IRPT holds good. Both are equal. When IRPT holds good. Okay. But if I look at the actual rate, I'll take the actual rates. So what is local interest? Actual interest rate is 10%. What about actual foreign interest rate? This is local. What about foreign? Foreign interest rate is 4%. And premium. What is premium? We'll calculate actual rate based on actual rate 76. 76 minus 70 by 70 into 100. 1 year only, so into 12 by m not required. 76 minus 70 by 70 into 100. 8.57%. 8.57%. This premium. Now, what is the total cost? You can do additive model or you can do multiplicative model. Multiplicative model we give exact answer. Additive model also approximately we can always do it. So what is that approximate number? Here it is 10% local. And here how much you get? 4 plus 8.57, 12.57. Now, local is cheaper or foreign is cheaper? Local is 10%. If you go for borrowing effectively it becomes 12.57. So which is cheaper? Definitely local borrowing is cheaper, right? So this is cheaper to borrow. Cheaper to borrow. And if you borrow in one currency, other currency you will deposit. So other currency, opposite currency, other currency, which is in this case foreign, deposit. Other currency, foreign currency, deposit. Okay. Of course, if local currency was higher rate, then I would have borrowed in foreign currency. This I explained to you by identifying which country is cheaper to borrow. I can also identify which country is costlier to deposit. But let's not think too many ways. Let's understand through borrowing, because even in exampling, most of the questions will be focusing on borrowing. Same thing applicable to deposit also. Local interest rate versus foreign interest rate. Local deposit is local interest. Foreign deposit, foreign interest plus the forward premium. You understand, right? If you're an Indian person, you invest in Indian stock exchange, you invest in Indian market, you get only Indian returns. But if you invest in US, you get US returns. That is investing in US market, as well as if dollar appreciate, that return also you will get. That way also you can understand. So wherever cheaper, whichever is cheaper, we borrow. Wherever is costlier, we invest. And you see here we identified cheaper to borrow. Format is same. I will not rewrite. Cheaper to borrow rupees means deposit dollar, means buy dollars. Later you sell dollars. You understand? Ultimate process will be remaining same. Only the starting point, either you follow currency market approach or you follow money market approach. Now, money market approach, I would like to write few summary points as well. But if you have any doubts, you can get it clarified. Okay, hope you've done. Let me do some more summary points regarding this identification of which currency to borrow, identification of currency for borrowing purpose. Sometimes they call it as covered interest arbitrage. Covered interest arbitrage. Different name, don't worry. So what you have to do is you compare for local borrowing, you take the local interest rates. For foreign borrowing, you take the foreign interest rate plus premium. plus or minus premium discount. Foreign interest plus or minus plus I'll say premium. You understand, minus means discount. So here you do borrow whichever is cheaper. Borrow whichever is cheaper. Okay, there is one more angle to it. I would like to cover that as well. Mathematically, it should be equal, right? If foreign interest rate comes to left side, that is called as interest rate differential. So if IRPT holds good, if IRPT holds good, then if I bring foreign interest rate to left side, foreign interest rate to left side, if IRPT holds good, then interest rate differential, interest rate differential should be equal to premium, approximately, of course. That is local interest minus foreign interest should be equal to the currency premium if IRPT holds good. If not holding good, there exists arbitrage opportunity. It's better to borrow in one country. If IRPT does not hold goods, if IRPT does not hold good, that implies they are not equal. So we can choose which currency is cheaper to borrow. So you write interest rate differential and premium. Interest rate differential, it is for local currency, for local borrowing, and premium is for foreign borrowing. Again, here also borrow whichever is cheaper, or invest whichever is higher, both ways. Borrow whichever is cheaper. So if interest differential is less, local currency you borrow. If premium is less, foreign borrowing you borrow. Like in this example, what is the interest rate differential? 10 minus 4, right? 10 minus 4, 6%. What is a premium percentage? 8.57. Which is the lower number between 6 and 8.57? 6% is lower one. So therefore, interest differential is lower. It's better to borrow in local currency and invest in foreign currency. Suppose interest rate differential is 7%, then also it's borrowing. Okay. If interest rate differential is, let's say, 10%, suppose, then which is a higher rate? It's better to borrow in foreign currency and make a deposit in local currency. I hope you are able to understand this clearly. Okay. One more small point to be kept in mind. You see, the formula what we applied here, that is 1 plus local interest by 1 plus foreign interest. In the exam question, one more situation can happen. They can give two interest rate, one for deposit rate, one for borrowing rate, and they can give two forward rates, one bid rate, one offer rate, one for buying, one for selling. So when they give you a spread, either in the interest rates or in the exchange rates or both. So when a spread is given, we can't identify this. Overprice, underprice does not work when a spread is given. In that case, you should try both the alternatives. What alternatives? You do spot buy, forward sell. What will happen? And spot sell, forward buy. What will happen? You should try both the techniques and see what will happen to you at the end. So let's write down that also just for reference. If spread is given, if spread is given in exchange rates and interest rates or both, if spread is given exchange rate interest rate, then overpriced underpriced approach, interest rate differential, both the methods does not work. So what you have to do is, in this case, you have to choose a trial and error method. No implied rate method, no IRPT method, trial and error method. Means what? You try both the alternatives. You try both the alternatives. That is, you borrow in local currency and deposits in foreign currency. This is one alternative. And you try other alternative also. Alternative 2, borrow foreign currency and deposit local currency. Then two situations can exist. Actually, three situations can exist. Possible scenarios. Possible scenarios. So this is first, second, three possible scenarios actually. First alternative gives, that is this alternative gives arbitrage gain, and this gives loss, or this alternative gives loss, this gives gain, or both loss and loss. Both cannot be gain, that cannot happen. So if you say gain loss, then you understand arbitrage opportunity exists in first alternative. So here first alternative, that is borrow local currency, deposit foreign currency, has arbitrage. So it has arbitrage. Loss here, gain here, yes, second alternative has arbitrage. But both are losses, that means there is no arbitrage. No arbitrage. That can happen when your implied rate is between the two spread given. Then you can also have situation. But anyway, don't think of those things. When they give you spread in interest rate exchange rate, try both the alternatives. If both are losses, no arbitrage. In one of the places, if you find any gain, arbitrage gain, then there is arbitrage opportunity. So if spread is given, we have to follow trial and error methods. Okay, so this is all about interest rate parity theorem, purchasing power parity theorem, their formulas, their interpretation, and to be specific, arbitrage. Okay, hope it is done. I'll go further.